Now students, next comes the concept of deferred revenue expenditure. See, these kind of expenditure are revenue in nature, okay, they are revenue in nature, but the benefits can be drawn from it for more than 3 to 7 years. Suppose for example, a farm spent 2 lakh rupees on advertisement, okay. Now this is revenue in nature, because advertisement expenditures are for daily to daily basis, okay, but this expenditure will give you benefit for more than 2-3 years. So this is a revenue deferred revenue expenditure. Next comes debtors. Debtors are very simple, the persons from to whom you have sold goods but not in cash, you have allowed them to pay you later on, that is, you have sold the goods in credit. So debtors are assets for you, because debtors can be converted into cash, because either today or next day they are going to pay you the money. Similarly comes creditors. Creditors is the person from whom you are purchasing goods on credit, okay, and so here the concept changes. Here creditor is a liability for you, because either today or tomorrow you are going to pay the money back to the creditors. Now bills receivable, I will later on tell you this about this in details, but just for now know that there is a negotiable instrument, bills of exchange. You have a chapter on in this. Bills of exchange is what? If you have purchased goods from someone, okay, and you have said them that you are not going to pay the money right now, you will pay it later on. Now the creditor has drawn a bill on you, okay, that bill will tell that how much money you have to pay, how much time the creditor is allowing you, and this type of bill is called bills of exchange. You have to accept it, okay. So when you are accepting the bill, that means you are allowing the creditor that you are going to pay the money after a certain period of time. So here you have to pay the money back to the creditor. So this is called bills payable. It is a liability for you, because here you have to pay the money. But on the contrary, there is bills receivable also. What is that? When you are selling goods to someone on credit and you are drawing a bill on that person. Now after that person accepts your bill, that becomes bills receivable for you, which means that that person is going to pay you after a certain period of time. Now this is an asset for you, okay, because here you are going to get the money back.